morning and welcome to today's live technical analysis. Appears to be slight issue with the mouse again. Just a moment. Appears to be slightly stuck. Apologies, it appears that we've been experiencing some technical difficulties. We should be able to continue our technical analysis now. So we're going to be looking at the Aussie against the US dollar. As you can see, it's moving in a downward trajectory, having broken below our upwards moving trend line, broken below support at 0.6605. So we're going to be readjusting our support and resistance levels. This could be support turned resistance. That you can see it met some resistance before making a clear break below. S1, we could bring it slightly higher, coinciding with these candles at this point in time. So 0.65355. So you might be asking, why is the Aussie moving in a downward trajectory, given that China's Caixin Services PMI figure came in better than expected? Well, to answer that question, I believe that is predominantly due to the RBA's interest rate decision, which happened earlier on today. The bank remained on hold as was expected, yet in the bank's accompanying statement, it appeared that it was predominantly dovish, essentially implying that the current interest rates are making their way into their economy. Despite the labor market remaining relatively tight, it appears to be loosening, and as such, they may maintain their current interest rate levels or could even proceed to a cut. That was not seen in the accompanying statement, but it could be the market's expectations, which is why the Aussie appears to be moving in a downwards fashion with the dollar gaining against it. So we have R1, R2, and R3. So this was support and resistance. This is S1, this is S2. And for S3, where our upwards moving trend line had begun and near the sideways moving channel, 0.6275. We're maintaining a bearish outlook for the pair, given that the RSI is below 50, actually near 30, 37 at this point in time, implying a bearish market sentiment in addition to the breaking below our upwards moving trend line. So for the pair, we're maintaining a bearish outlook. Now, something which is probably interesting for the majority of you watching at home is gold. As you can see, gold created a new all-time high at the 2,136 figure. It appears that the markets are disregarding the statements made by Fed officials. And why are we saying that? Well, on Friday, it could be said that Fed Chair Powell was slightly hawkish. In such a scenario, we may have seen gold weakening as the dollar was expected to potentially strengthen. But it appears that did not happen, and markets have disregarded that comment and are essentially saying, we believe that you're going to cut, whether you're admitting it or not, which is why you may have seen gold actually spiking up to the 2,136 level. It has now broken below our old R2 and R1 levels, broken actually below support at 2048. So this is a 4 hour chart. On the daily, it's moving in downwards fashion today. We anticipate that this is probably a market correction to lower ground. On the 4 hour, it's near 50. So you could say it may be moving in sideways fashion. But for it to move in a sideways fashion, it will have to fail to break below S1 at the 2020 figure. 2020, you have R1, 2048, then R2. Now the question is, do we keep R3 or do we simply remove it? Well, I think we could actually we could place R2 at the 2088 figure and simply remove 2100 that we had. So you have R1, R2, and R3, which was the all-time high. Now, for a sideways bias, it needs to move between S1 and R1. It's broken below two upwards moving trend lines. And as such, we're not maintaining a bullish outlook for the precious metal at this point in time. We also need to look at S3, which could be at this point here. Let's just check why, and I'll show you in just a moment. So, as you can see, the precious metal found support at this point in time. This was actually an old support level, which broke above. So this was a high, broke above, moved higher. Wick down below, did not close though. Wick touched on the support line, failed to break, managed to break below, support and resistance, resistance and support, then once again, and then found support once again before moving higher. So the 1957 figure is, in my opinion, a valid S3 level. So you have S1, S2, and S3. The difference, well, the reason between the distance between our support and resistance levels is based on this price action here. You can see, even if I had placed our resistance at 2100, it would have easily broken low. It's moved lower. Therefore, we're giving it room to breathe, quote unquote, because it could move either significantly in a downwards fashion, could stay sideways, or could come back up higher. Personally, I think that it's actually going to move in a downwards fashion, correcting lower, perhaps down to S2. So for a bearish outlook, it would need to break S2 as well. Whereas for a bullish outlook, simply breaking above R1 and moving higher, perhaps towards R2. So breaking above R1 and aiming for R2. For a sideways, simply failing to break below S1 could be the beginning of a sideways fashion for the precious metal. So that's for gold. We're going to be looking at oil. So some new developments. It appears, based on a news flash that was on Bloomberg about 30 to 40 minutes ago, Russian President Vladimir Putin is expected to visit Saudi Arabia and the UAE tomorrow. So why may he be visiting? It's been stated that he may be discussing the current production levels. It makes sense that Saudi Arabia would want more oil production cuts, while Russia may have wanted to increase supply into the markets. So they may be discussing OPEC's next steps after Q1. Now, it should be noted that a Saudi energy minister stated that oil production cuts could be extended from Q1 2024 as well, which may have provided support for oil's price, but appears to be moving still in a downward fashion, having broken below and actually staying below R1 at the $75 mark. We could keep our support and resistance levels as they were previously. RSI, it's not at 50 yet, but between 30 and 50. So still there is some bearish sentiment in the market. So I'd maintain a bearish outlook on oil for now. What is interesting was over the weekend, the people of Venezuela voted in favor of a referendum reaffirming the country's rights to the oil-rich region of Essequibo, if I'm not mistaken, which currently belongs to Guyana. Should Venezuela decide to act in terms of a military aggression, potentially invading, but it does not appear to be the case at this point in time, and it should be noted. But if they do decide to take military action, it could, in theory, provide some concerns from the supply side of oil, which could actually provide some support for oil's price. But for now, maintaining a bearish outlook. If it fails to break below above R1, we would maintain our bearish outlook. If it breaks below S1 as well. For a bullish outlook, simply breaking below above R1 would be sufficient. Moving on to the euro against the US dollar, it appears that the dollar is gaining. The dollar, yes, is gaining against the euro. Now, that could be attributed as well to ECB board member Schnabel's comments earlier on today, in which she indicated that the ECB may have reached its terminal rate. And given that she is known to be a slight hawk, these dovish remarks could potentially weigh on the euro, as appears to be the case. And for actually R1, we could simply bring it up higher, 1.0875. Zoom out. Validating our downwards moving trend line, broken below R1. RSI near 30 implies a bearish market sentiment. For S1, we could actually bring it higher to this previous high, 1.0750. And then for S2, we're taking these four candles. Appears I found some support at this level. So 1.0617 for S2. Then you have S1, 1.075. S3 at 1.0490. R1, 1.0875. R2, 1.1040. And then R3, 1.1265. So for now, we're maintaining a bearish outlook on the pair. The pound against the US dollar, we need to readjust our support level. And if we bring it around here, zoom out, you could say that since it's broken our upwards moving trend line, the pair appears moving in a sideways fashion. So we could bring R1 closer as well, 1.2720. And then we could actually place a sideways moving channel. So moving in a sideways fashion, we're moving our old S3. So you have S1, then S2 could be brought slightly higher, 1.238, 1.2390. And then for S3, at the beginning of this upwards moving trend line, which was broken, so 1.2195. Then for resistance, we could bring actually our resistance levels much lower. And let's see, to close previous high, 1.2870. Let's just zoom in so you can see which point I've actually taken. Broken below, came back up, found resistance, and then moved lower. And then for R3, previous high, beginning of a downwards moving trend line as well. It could be said it's far apart, but we're looking at it from a more macro perspective. 1.3135, 1.287, and then 1.272 sideways pass if it remains between our sideways moving channel. Bearish outlook simply breaking below S1. Bullish outlook simply breaking above R1. We're going to be looking at the dollar against the loonie. So dollar CAD, we note Canada's interest rate decision, which is due out tomorrow, if I'm not mistaken, widely anticipated to remain on hold. Based on the current oil prices, would not be surprising if they express concern, which could further weaken, which could weaken the Canadian dollar. It's found support, broken above once again. For now, it maintaining a sideways bias between S1 and R1. It's broken above resistance turn support again at 1.3535. The RSI indicator is at a reading of 50.89, so implying a neutral market sentiment. And based on what we're seeing, simply bring R1 slightly lower, 1.3620. For R1, sideways between S1 and R1. Then we could bring R2 lower, 1.3777 or 3775. 0.3775 for R2. R3 we could keep at 1.39. You could see perhaps the formation of an upwards moving trend line. If we extend this downwards moving trend line, see where they coincide. Let's see if it manages to break above this upwards moving trend line for a sideways bias to be confirmed. For a bullish outlook, simply breaking above R1. Bearish outlook, breaking below S1 and moving towards S2, which actually could be readjusted to be brought higher. Taking these candles here, 1.3405 for S2. For the Australian dollar, we also note Australia's and China's trade balance tomorrow. Should China's imports should they come in higher than expected, we may see the Australian dollar gaining some support, potentially reversing some of the losses made during today's trading session. That's why it may imply that China's economy is actually rebounding or could be on the road to recovery. Therefore, higher imports, which means higher demand for Australian goods given their close economic ties, could provide some support for the Australian dollar. And as well, Australia, in terms of exports, greater amount of exports, perhaps providing some support for the Australian dollar. But based on China, I do not see that happening, but it could. So we should note that as well. We've kept oil, we've done the loonie. Upwards for now, sideways if it breaks above this downwards moving trend line and fails to break above R1. Bearish outlook simply breaking below S1. Bullish breaking above R1 would be sufficient. Dollar JPY found support, actually could be moving in a sideways fashion. If it comes back down to S1 and fails to break below S1, then we could see a sideways movement being formed, RSI near 50, so neutral sentiment for dollar against the Japanese yen. Tokyo's core CPI rates came in lower than expected earlier on today, which may hinder the bank's potential ambition to change their monetary policy stance. Therefore, perhaps if they maintain their ultra-loose monetary policy, as they currently have, it could weaken the Japanese yen. But for now, sideways, narrowing of the Bollinger Bands between S1 and R1 further validate this hypothesis. So in between S1 at 146.25 and R1 at 1.48.30. Bullish outlook, simply breaking above R1 and moving towards R2. On the other hand, for a bearish outlook, simply breaking below S1 at the 146.25 trigger would be sufficient for a bearish outlook. Now, what we have next, British pound, we've done the euro, the British pound as well. We've done the Aussie, we've done the Canadian dollar, we've done gold, we've done oil. Moving pretty fast today. Perhaps we could do Tesla as well. This gap appears to have been filled. 248.80 R1. This was resistance turn support. 225, R1, S1, S2, and S3, R1, R2, and then for R3, 290.65. So why am I picking Tesla today? There's been some reports that um, workers in their manufacturing plants in Sweden or Finland, I'm not sure which country it was, are preparing to go on strike, which, if it's prolonged, could weigh on the company's stock price, although could have a relatively minimal impact, potentially remaining between the sideways channel formed between S1 and R1. Now, for this to be a valid sideways channel, it's actually not touching on S1, so let's remove this for now. Narrowing of the Bollinger Bands, RSI near 50 imply a neutral market sentiment for Tesla's stock price. If it comes back down to S1 and fails to break below S1 and then moves higher, then yes, perhaps we could validate our sideways hypothesis with a sideways moving channel. If it breaks below S1, we would switch to a bearish outlook, with the next target for the bears being the $195.60 mark, and then a greater target could be 165. For a bullish outlook, simply breaking above R1, so 248.80, and then next target being 266. Goldman Sachs, we've looked, so we've done a Tesla, we've done the majority of the pairs. If there's something you'd like to see, feel free to ask. We can go over it together since we have enough time today. So we've done dollar JPY, we've done the British pound, we've done the euro, we've done the Aussie, have not done the Kiwi though. We can look at the New Zealand dollar. So this is simply resistance and support, S1, S2, and then you have S3, and then S4 and even S5. But let's just remove them. Bring R1 lower, 0.62105. This may have been an upwards moving channel which was broken, so we're switching to a bearish outlook, RSI dropping below 50. For it to be validated, simply breaking below S1. And now we're looking for R2 and R3, taking this previous high. So you can see here, 0.6255, but it appears to be close to R1. So perhaps something higher, previous high as well, 0.6305 for R2. And then for R3, this previous high here, 0.640, so 0.6402 actually. There we go. So you have R1, R2, R3, S1, S2, and S3. I would be switching and maintaining a bearish outlook for the pair if it breaks below S1. Let's move on to, we've done oil as well. We've done gold. Let's look at the S&P 500. Let's move on to the daily chart. Let's clear our support and resistance levels, and we'll go through the process together. So we have a clear chart. Let's remove these lines as well. So Bollinger Bands have widened, implying some volatility. RSI near 63, so some bullish market sentiment for the S&P 500. So let's begin. Support level. We can see that it's meeting support at this point. You can see that it closed on this level, opened, validated by 2 wicks, and moved slightly higher. So this could be the first line of support for the S&P 500, 4,535. S1. For S2, we could take this previous higher low, 4,345. So this could be S2. We're giving it enough distance as well if it decides to break below S1. And then for S3, taking this previous low. Swing low, as a matter of fact, 4,115. So you have S1, S2, and S3. We're keeping the distance between our support levels equidistant, so the same amount of space provided for S1 to S2. And then from S2 towards S3. For resistance, you have two options. You could have a very narrow support and resistance level, which personally I do not like. I'd rather keep it slightly higher, which means we have to go back. Price action is currently at this point, as you can see to the right of your screen, 4,555. So a resistance level is previous high, an old high, as a matter of fact. Between the 18th of March and the 30th of March 2022, 4,630. So this would be resistance R1. R2, you can have a moment to think where you might have placed your resistance level of R2. I can see two options, but one would be relatively close to R1. If you had thought about placing your resistance level at R1, R2 here, 4,726, you may not be wrong. There may be some resistance here, but if you're considering the distance between S1 and S2, you can see between R1 and R2, it's fairly close to each other. Therefore, given that we're maintaining the same distance between our support levels, we should do the same for our resistance levels. So this would be the second level. Why? You can see numerous candles attempting to close above this resistance level. It failed to break above. And then you can see this bearish candle that moved below. So it tried one, two, about 7 times. And then when it failed, it moved lower. So this is a more significant resistance level, in my opinion. Oh, accidentally moved resistance 4,795. Then for R3, all-time high. All-time high. Okay. Now, based on what we're seeing, if it does move higher, it would be aiming for a new all-time high, which is roughly at this wick. Since we're on the daily chart, we're looking at a more macro perspective. So this would be open high. The highest 4,819 would be its all-time high if it breaks above that point. So how could we potentially find our new all-time high? Distance between R1 and R2, 16561. 4,958 for R3. So R1, R2, R3, S1, S2, and S3. This is on a 4-hour chart. It appears to be moving in upwards fashion. Bullish outlook needs to break above R1. Now, if you move on to the monthly chart, you can see it moved higher, came back lower, and then is continuing its upward trajectory. Strong bullish candle, but if you look at the RSI, appears to be aiming back towards 50, which could be a market correction to low ground to S2. So it depends on what time frame you're looking at the index. For now, from a 4-hour perspective, it appears to be moving in a sideways fashion between S1 and R1. On the daily, appears to be moving to touch support at 4,535, but from the other side, you could maintain a bullish outlook for the S&P 500. Yet, it did break our upwards moving trend line that we've placed around S3. So, from a bullish perhaps to a sideways bias, but the RSI is implying some bullish sentiment remaining. Personally, I would be sideways, so neutral bias, but if it breaks below S1, I would switch to a bearish outlook. Nasdaq 100 appears to be moving in a downwards fashion. Let's readjust. Note touched by the wick on two occasions, broke below, failed to break above, and continues moving lower. So this would be my R1. At the beginning of this bullish candle would be my S1. Then S2, 15,120. Then S3, 14,720. You could say that this is actually forming a downwards moving trend line. RSI near 30, implying a bearish market sentiment, broken below support and resistance, further validating our hypothesis. And for R3, one thousand 16,450. Now, it might actually be more prudent to take this previous resistance level. Though I do think it might actually meet resistance if it does come back up. But from a more macro perspective, let's just keep this. $16,565. S1 15,510, S2 15,120, S3 14,720, R1 15,826. We could actually put 25. R2 16,175. That could be brought slightly lower. 16,164. Then R3 16,565. Yes. But I would be maintaining a bearish outlook for the Nasdaq 100. Downwards moving trend line, broken below support and resistance. RSI as well, implying a bearish outlook for the index. Look at Airbus, Alibaba, Lockheed Martin. What should we do? What should we look at? We could do Amazon and Apple. So for Apple, I need to bring S1 higher because it was lower. You can see significant distance between the price action, so it needs to be readjusted. Previous high, 1,800, 186.20, not 1,000. And then previous high, 181.26. Bit too close. And then I take support at 175.50. Simply looking at the chart, you can see there's a bullish candle which opened, came back lower, closed at this point, broke above, moved higher. Then you have 4 candles here validating that as a support level. Then if you look back in time, you can see also some candles here, so validating this as a potential support level. For R1, 189.50 is being brought higher. 191.10. We can keep R2, 196.15, and then we can keep R3, 202.38. For now, we had extended upwards moving trend line would have been broken, so disruption in the upwards momentum, RSI near 50, sideways between S1 and R1, but it needed to validate S1, failed to break below, and then fluctuate between S1 and R1. For a bearish outlook, simply breaking below S1 Bullish, it would need to break above R1 and aim for R2, so breaking above this point as well to validate that it's actually moving in upwards fashion. Amazon, actually, we can do Facebook, given that I read that Mark Zuckerberg has sold shares on Facebook, so that could potentially weigh on the company's stock price. And then S1, 10.38, S2, 9.58, R1, 10.84, then R2, I'll ignore this candle as it would be too far away from R1, 11.55. Instead, I'm taking these candles here, this wick. And then for R3, previous high, 12.15. And now we're going to be looking for S3. To start off this upwards momentum. Or you could say upwards primary trend. So it failed to break above, came back lower, managed to break above and opened and then moved. But it's too close to S2. So taking this previous low instead, 8.75. So this could have been the primary trend. Going lower. Continuation, then could have been an intermediary before moving lower, came back down. And here we are. So you have S1, S2, S3, R1, R2, R3. This is for Facebook. From a technical point of view, S1 and R1 are very narrow, so I wouldn't be talking about a sideways motion here. Fundamentally, perhaps bullish based on the RSI between 50 and 70, implying a residual bullish market sentiment. So perhaps moving in upwards fashion. If it breaks above R1, if it breaks below S1, then I would switch to a bearish outlook for the company's stock price. UBS, S1, 26.79, then S2, then S3. We need to find R1, R2, R3. Okay. Let's see. R1 immediately at this previous high, 28.59. Now we can measure the gap between 68, could potentially jump 29.31, but the distance between S1 148, so let's take the distance. 30 $30 per share. And then $31.5 as R3. R1, R2, R3. Let's just check our text labels as well. R2 at 30. At think we discussed about Canada, about there being their interest rate decision tomorrow. Yes, we did. 28.59. Also discussed China's and Australia's trade balance. Uh, we'll be talking tomorrow as well, following the release of Australia's and China's trade balance, so we can see what impact may have occurred in the market. So we'll pick up from there in tomorrow's live technical analysis session. If you'd like to ask something tomorrow or today, feel free, or you could prepare some questions for tomorrow. So we have S1, S2, S3, R1, R2, and R3. We've done Amazon, we've done Apple. I haven't done Amazon. We've done Apple, Facebook, UPS. We've done Tesla. We haven't done Goldman Sachs. Morgan Stanley appears to be moving on an upward trajectory. Nice. Goldman Sachs also moving on upward trajectory, broken above resistance, turn support. Slightly lower. 122.79. First moving trend line being formed, aiming for R1. 352.70. Personally, I like to see how Goldman is doing. I think Goldman's move to get out of the consumer lending sector, which was unprofitable for the bank, is a good choice. I think by cutting their losses, they may actually focus on their strengths, which could actually improve the company's stock price. Yeah, this is Goldman. Up and up, RSI 70, so bullish sentiment for Goldman Sachs. From a fundamental point of view, I support this theory as well. Up and up, upwards moving trend line, aiming for R1. Bullish outlook to continue. Breaking above R1. Then next target being R2, 367.95. Finally, R3, 381.40. S1, 332.79. S2, 317.55. S3, 304.40. And perhaps we might do Apple. What we've done Apple. So this was another chart. Deutsche Bank. See. Bullish outlook for Deutsche Bank as well. Finding some resistance here, but RSI supporting that theory. Sociedad General, after this magnificent drop, is actually rebounding. Bounced off our support level. So support and resistance levels still stand as they were previously placed. 23.80, 25.37, 26.60, and then 22.45 for S1, 20.75 for S2, 19.10 for S3. And with that, I think we're done for today. Let's just check one last moment our Australian dollar against the US dollar. It's on a 5-minute chart. 4 hour, 1 hour, half an hour. All appear to be pointing towards a bearish outlook for the pair. And with that, that does it for today. And I'll see you tomorrow.
So today's session, as I mentioned earlier, is about trend trading. So as per usual, just a disclaimer before we get started. A risk warning, our products are traded on margin and carry a high level of risk, and it is possible to lose all of your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice and or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. So IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I will be your speaker for today. I'm an investment analyst from the company Everest Fortune Group, who were finalists for Best FX Research and Best Equity Research in the years 2019, 2020, and 2021. So here's our agenda for today. We have quite a number of slides to get through. So if you have any questions throughout the webinar, feel free to pop them into the chat or in the Q&A session, and I'll be happy to answer any questions you have. So this is our agenda for today. Firstly, we'll go through what exactly is trend trading and how to identify a trend using trend lines and channels. And then we will look at the different indicators that you can use and how you trade using these indicators. Next, we'll look at a couple of disadvantages of trend trading and how you can overcome these disadvantages. Okay, let's get right into it. So what exactly is trend trading? So it's a popular strategy used in Forex markets by traders to take advantage of the directional movement of currency prices over time. So as a beginner, understanding trend trading can help you to make more informed trading decisions. So trend trading is based on the idea that currency pairs tend to move in certain directions for extended periods of time before reversing. These movements can be upwards, referred to as an uptrend, or downward, which would then be referred to as a downtrend. So the goal of trend trading is to identify and capitalize on these sustained price movements. So statistically, a trend is more likely to continue than to reverse, and that's why a trend is assumed to be in effect until it gives a clear signal that it has reversed. Hence the sayings, the trend is your friend and you should never go against the trend. But of course, there are a couple of exceptions to this, so we'll talk a bit about those later on in the webinar. But the general rule is that when you follow these trends over different time frames and stay away from markets when they are not trending, then traders can then increase your profits by making these opportunities. So how exactly does it work? Excuse me. So here's just a simplified breakdown of how trend trading works and a couple of steps that you can take. So firstly would be identifying trends. So this would be an uptrend would be higher highs, and then a downtrend would then be lower lows. So this is typically done by analyzing historical price charts. Next would be your entry points. So once you've identified the trend, the next step is to find an opportune entry point. So over here, I've given an example of an uptrend. So during an uptrend, you might want to look to enter a trade and when the price has retraced slightly from its recent high. So this suggests that the trend will then continue. Alternatively, in a downtrend, you might look for a retracement before the price continues in its downward movement. Thirdly, we have setting stop loss and take profit levels. So to manage risk, it's crucial to set stop loss and take profit levels. So SL is stop loss, TP is take profit. Just to be sure. Okay, so a stop loss is a predetermined price at which your trade will automatically close and limit potential losses if the market moves against you. So this is also a risk management technique that we'll talk a little bit later. Next, a take profit level is where you decide to exit the trade to lock in your profits before the trade potentially reverses. Next, for number 4, we have riding the trend. So once you're in the trade, you have your risk management levels, so your stop loss, your take profit levels, all accounted for. Then, and your trend continues, then you can aim to stay in the trade as long as the trend remains intact. So this involves monitoring the price movement and adjusting your stop loss and take profit levels if needed. Number 5, exit the trade. So eventually you can expect the trend to reverse or weaken. So at this point, you might decide to exit the trade and take your profits because it's important to note that trends will not last forever. So it's important to observe your trades and be vigilant and not get too greedy. Lastly, practice and analysis. So this is pretty self-explanatory. Like any trading strategy, trend trading requires practice and analysis. So you want to keep refining your skills by studying the charts and learning from your successful and unsuccessful trades. And of course, keeping updated on market news and events that could impact currency prices. Okay, so we talked a little bit about setting stop loss and take profit levels. So I just want to dive into that a little bit. So firstly, we have a retracement, which is what we talked about in the previous slide. So let's start off with pullback support and resistance. So pullback support is a strong level of support and it breaks out from a previous resistance level. Now price is dropping back to visit it again. So a tip is that when a pullback support lines up with a Fibonacci level, it's typically considered to be very powerful. Here we're talking a little bit about Fibonacci levels, but if you're a bit confused about those, not to worry, we have an entire Fibonacci series on the different types of Fibonacci's. So you can go ahead and take a look at those. But the point that I'm trying to drive here is basically the introduction of a pullback support and resistance for your that could be used as your entry and exit levels. So pullback resistance works well when it breaks a significant low, as you can see from the chart here. So it breaks the level and then it makes a significant swing low and then it starts to pull back to this level. So that's why we call it a pullback. So we advise that it's even better if there are multiple Fibonacci levels that are lining up with it. So here's an example of a pullback support. Here we have 3 swing highs that line up in the same area. So remember that these are typically areas, not so much levels. So we have 3 areas that line up and price has passed through this level and it looks like it's made a swing high and it's coming back down to bounce off of this level. Excuse me. So here we have, we're expecting price to bounce off of this level, and that's why we call it a pullback, because we're expecting price to pull back to this level. So this green area here is now considered a pullback support level. Okay. Next, let's take a look at the pullback resistance example. In this example, we have 3 swing lows that line up in the same area, as you can see from this green area here. So the green area is our support, but once price breaks out of this support level, and we are expecting it to reverse off of it, then you can call it a resistance, a pullback resistance. Okay, so as you can see from the arrows, we're expecting price to pull back to this level here. So here's another example, but over here we have a actual example screenshot from a chart. So we have a swing low here and price is moving up. It's made a reversal over here. That's another way that you can identify trend reversals by looking at the swings, but we'll get into those in a little bit. So we have a swing high here, swing high reversal, it's going down, and then it surpassed the swing low support, and that's why we are expecting it to reverse back to this support level. But now that it's surpassed this level, it's now a resistance. So it is a pullback resistance in this case. Okay, next we have another pullback resistance example here. Actually, this is a follow-up from the previous slide. So this is the previous slide. We're expecting price to reverse off, and that's exactly what it did. So it reversed off of this swing low, reversed off, and it hit it right back to our pullback resistance just as we expected. But what happens when price reverses off of this pullback resistance? So that's what we call a overlap support or resistance. So this overlap support and resistance basically occurs when price reacts off of a particular level from the top and from the bottom. So basically it means that when a swing low, as you can see from the GIF, lines up nicely with a swing high, then that's what we call an overlap level. So the more times that it reacts off of this level, the stronger the overlap area. This means that there are bulls and bears that are respecting this area, and that's why it's so important to take note of these areas. Okay, another pro tip, so if the overlap area lines up with other elements such as Fibonacci or graphical elements, it will make it even stronger. Okay, so here's an example of an overlap support or resistance. So it's basically a pullback support or resistance, just that price has actually reversed off of the level. Okay, so swing low support becomes a pullback resistance, as you can see from this screenshot. Once it breaks the support at this 105.643 level. So here in this GIF, you can see how price retraced back to this level or pulled back to that level, and then it proceeded to reverse off of that level. So once the reversal occurs, then it is an overlap resistance. Okay, let me know if there are any questions so far, but I hope this is pretty straightforward. Oops, sorry about that. Press the wrong button. Okay, next slide. So now we're looking at a combination of the pullback and overlap levels. So here we have a big swing high resistance level, as you can see here at the first red arrow. And then it becomes a pullback support where we expect price to pull back or retrace this level once it has passed that swing high resistance. So it surpasses it, and then we're expecting it to come back to it. And that's why it is now a pullback support. Once price actually touches that pullback support and it reverses off of it or it bounces off of it, then we can call it an overlap support instead. Okay, you can take a look here for a while and let me know if there are any questions so far. But we do have a couple more examples in case you are confused. Okay, let's move on. So here's another example. We have a multiple swing high resistance. You can see from the purple circles here, one swing high here and one swing high here. Next, at point number 2, I have an arrow indicated here. That's where price surpasses the resistance. So price surpasses the resistance, and then we call it a pullback support. So you can see how the resistance then changes to a support level once price surpasses it. So we are expecting price to pull back, and then it did. So point number 3, price has pulled back to our support and has in fact bounced off of it twice. So at the blue circles, you have 2 swing lows that line up nicely with these 2 swing highs originally. Once price has bounced off of this level, the 0.68745, then you can call it an overlap support. Okay. Okay, our last example before we get into how we can identify a trend. So our last example, pullback and overlap. Here we have multiple swing low supports, 1, 2 here, and then price has pulled back, or rather it has surpassed our support level, multiple swing low support. So it surpassed it, and we are expecting it to reverse back. We're expecting to reverse back because we have observed this swing low. Okay, so we observe the swing low, we see price approaching it, and we're expecting price to reverse off of it. And you can see that's exactly what happened. We have 1, 2, 3 swing highs that line up nicely, and they're all making it an overlap resistance instead. So we see price then break out of this overlap resistance one more time. In this case, since it was a resistance here, once it breaks out of that resistance, it's now a support level. And as usual, we're expecting it to pull back, which is why point number 4, it's a pullback support. And lastly, point number 5, price has pulled back to our support and reversed off of it, making it an overlap support. So you can see the swing low here, reversing right at the exact same 33420 support level. Okay, any questions so far? Okay, okay, no questions. Let's move on to our next part of the webinar. How do you identify a trend? So this brings us to our next point, which is identifying trend lines as well as trend channels. So these can really help you to identify a trend. But how you identify a trend is pretty straightforward just by looking at a chart. I'm sure you can tell whether price is moving up or down. And it's also important to note that you should be looking at the different time frames for the specific asset that you are looking at and not just at the time frame that you are analyzing. So it's important to get an overall view of the direction of where prices are headed towards. So upwards, downwards, or ranging. Okay, so let's get into how we can draw valid ascending trend lines. So ascending trend lines should be drawn from the bottom and not from the top. So here we have an example. And trend lines should also have at least 3 significant touches in order to be considered valid. Because 2 touches tend to be more coincidental, and that's why we go for at least 3. Okay, so here's a couple of examples to show you how significant exactly these swing lows should be. So I have one really big swing low here and one swing low here. So that's how clear your charts should be when you are analyzing for trend lines and trend channels. Here we have another example, 3 trend lines, or rather 3 points touching the trend line. Actually, we have another small point here. And now for descending trend lines. So same thing, a descending trend line should have at least 3 significant touches as well. But for descending trend line, the lines should be drawn from the top and not from the bottom. Okay, here's an example. Here we have really nice 4 swing highs that touch our trend line. Okay, once again, take note of how clear the price movement should be. Yeah, you want to look for something with really clear movement in price. You can see exactly where the peaks are and the troughs are. Here's another example of a descending trend line. So you want to watch out for at least 3 significant touches in order for it to be considered a valid trend line. And here you see price playing the reaction off of the 4th touch. So it is breaking out of the 4th touch, 4th swing high on this trend line. Okay, so here we have a little activity. Let me know in the chat or in the Q&A session if you think this trend line is valid or not. In this case, of course, we can all agree that price is moving downwards. So we are expecting to draw a descending trend line. So let me know if you think this trend line is valid or not. Okay, so this trend line is not valid because remember for descending trend lines, we want to make sure that we draw the line on top of the charts. Okay, next, let's take a look at drawing valid channels. So channels typically require at least 4 significant touches to be considered valid. You need 2 at the top and 2 at the bottom. But they don't have to be in consecutive order like what we see in the picture here. Okay, so here are some examples. We have a descending trend channel here. Remember, 2 touches on top, 2 touches below. And once again, take note of how clear the charts, or rather how clear the price movements should be. Here we have an ascending trend channel. So, of course, it doesn't have to be in consecutive order as we mentioned earlier. Doesn't have to be in consecutive order. You can have some price movement in the middle, but as long as there are 2 touches on top and 2 below, then it's considered a valid trend channel. So these are just some graphical tools that you can use when you're trying to identify a trend. And this is typically the first step whenever we want to analyze a chart. So if we have time after the slides, I'll go through maybe one setup. I think we only have time for 1 or 2 setups. So but I'll definitely go through the different steps that you can take to identify a trend and how exactly you can use that in your trading strategy. Okay. Next, we have the different indicators that you can use to identify the trend. So we're going to be talking about the different indicators that you guys can use, but let me know in the chat what are your favorite indicators to use. Yeah, just curious to know how many of you guys actually use some of these trend indicators. Firstly, we have the Ichimoku cloud. So I'll just briefly go through how exactly you can use the Ichimoku indicator. But I wanted to mention that this is not a webinar for Ichimoku strategies. So we have another webinar that is solely about how we can use Ichimoku, not just the cloud, but the different lines involved as well, that I'm going to talk about in the next few slides. So you can go ahead and take a look at that webinar instead. But for this webinar, I'll just be breaking down the different lines and giving you a summary of how exactly you can use it. Okay, so the Ichimoku Kinko Hyo is a technical analysis tool that's used in Forex trading. So it consists of several elements, several components, including the Tenkan-sen, the Kijun-sen, Senko span A and B, and the Chikou span. Okay, I hope I'm pronouncing those right. But basically, these lines include a 9-period average, 26-period average, average of these two averages, 52-period average, and a lagging closing price line. So the cloud is a key part of the indicator. And how people use Ichimoku for trading is basically 1, to identify trends, 2, as support and resistance, and 3, confirmation, as well as buy and sell signals. So if we're just looking at the cloud only, which is the most, I guess is the fastest way, because you just look at it at one glance, it tells you exactly what the indicator signals are. So over here, I'm telling you guys that when price is below the cloud, then the trend is downwards, or it's suggesting a downward trend. When the price is above the cloud, then the trend is typically upwards. Trend signals are strengthened if the cloud is moving in the same direction as the price. So for example, during an uptrend, the top of the cloud will be moving up, or during a downtrend, then the bottom of the cloud will be moving down. So the top of the cloud, the bottom of the cloud, these both have names as well. So you can see over here. So we have the Tenkan-sen, which is the conversion line, which is the average of the highest high and the lowest low over 9 periods. The Kijun-sen, or the standard line or baseline, is the average of the highest high and the lowest low over the past 26 periods. Chikou span, which is the lagging span, is the current closing price plotted 26 periods behind the current time. So these are pretty technical meanings of what the lines mean. So, but we typically will only look at the cloud. It depends on your own trading strategy. Okay, next we have explaining the lines. Oh, I didn't talk about the Senko span. Okay, so Senko span A, or the leading span A, is the average of the conversion line and the baseline plotted 26 periods ahead of the current time. And that is a leading indicator of the trend. For Senko span B, D is the average of the highest and the lowest low of the past 52 periods plotted 26 periods ahead of the current time and used as a leading indicator as well. Okay, next we have explaining the lines and identifying trends. So here we get into what each of the lines, or rather how you can use each of these lines. So the first way is to use Ichimoku to identify trends, which the Tenkan-sen and the Kijun-sen can help you with. So a bullish trend occurs when the Tenkan-sen is above the Kijun-sen. So Tenkan-sen is the conversion line and the Kijun-sen is the baseline. Yes, correct. Okay, so over here in the chart that I've included, the Tenkan-sen is the blue line or conversion line, and the Kijun-sen is the red line or the baseline. So bullish trend occurs when the blue line crosses above the red line. And then a bearish trend occurs when the blue line crosses below the red line. Okay, next, the second way is for support and resistance. So this is just extra. So the first way was to identify the trends. Now the second way is to identify potential support and resistance levels. So the Senko span A and B, which I mentioned earlier, are the leading indicators. These can determine support and resistance levels. So if the price is above Senko span A and B, then it's considered to be a bullish market. So in this case, Senko span A and B, as you can see in the screenshot that I took from TradingView, you can see that these outline the clouds. So it's basically used as the same way as I mentioned earlier. When price moves above the cloud, it's bullish. When price moves below the cloud, then it's considered bearish. So same thing, if price moves below Senko span A and B, it's considered a bearish market. And these lines can also act as resistance levels, since they are specific levels as you can see here. Okay, so second use of Ichimoku, first use was to identify trends, and second use is as support and resistance. Okay, thirdly is for confirmation. So the Chico span is used to confirm the signals that's generated by the Tenkan-sen, Kijun-sen, and Senko span. So the Chico span is the lagging indicator here. And you can see I've shown you guys what it looks like on TradingView. So it confirms if it's above the current price, then it confirms a bullish trend. And if the blue line is below the price, then it is a bearish trend. So we just use this for confirmation of the trend. So after you've analyzed or you've gone through the first two steps, so you identify the trend and we analyze the different lines, then this would be the third way to confirm the trend. Okay. Next, we have as buy and sell signals. So these depend on the positions of the various components. So for example, if a buy signal is generated when the Tenkan-sen crosses above the Kijun-sen, and a sell signal is generated when the Tenkan-sen crosses below the Kijun-sen. Okay, so all of these different lines can, when you analyze each of them, if they all line up nicely, then you have a very strong either bearish or bullish signal. Okay, so how do we use the indicator, the Ichimoku indicator effectively? So the overall trend is up when the price is above the cloud and down when price is below the cloud. So traders will often just use the Ichimoku cloud as an area of support and resistance depending on the relative location of the price, which is what we talked about in the second step, and we've shown you how to do this as well. So the cloud provides support and resistance levels that can then be projected into the future. So this is what sets the Ichimoku cloud apart from the other technical indicators that only provide support and resistance levels for the current date and time. So as I mentioned earlier, we like to typically just look at the cloud if you are looking for an indicator that's very easy to read, or you cannot, you don't really have the time to analyze each of the lines. Ooh, okay. So yeah, as I mentioned, this is how we use it by just looking at the cloud strength. So price is moving below the cloud, giving us a bearish signal. Here, when price crosses over, this is where we see a trend reversal, and you can see exactly right when this happens, price moves in an uptrend, and it's also moving above the Ichimoku cloud. So it's all very bullish signals. So this is what you want to look for whenever you are using the Ichimoku cloud. Okay, so far, if there are any questions, feel free to let me know in the chat. Okay, if there are no questions, we'll move on to our next indicator that we're gonna look at. So in this example, we're gonna look at using the moving average indicator. So price XMA is a cross-trading technique that is quite simple to use. So it involves using two moving averages of different periods to analyze price movements and generate buy or sell signals. So if you're unfamiliar, just a brief introduction to moving average indicator. So the moving average is basically a smoothened line, as you can see here. It's a smooth line that represents the average price over a specific number of periods, of which you can control when you're using MT4, MT5, or TradingView. So it helps to smooth out price fluctuations and highlight the underlying trend. So there are a couple of steps for this strategy. Firstly, you choose two moving averages. For example, here we are using a shorter period moving average, which is 20-day, and a longer period moving average, 50-day. The buy signal occurs when the shorter moving average, so in our case, the 20-day, crosses above the longer moving average, suggesting a upward trend. So in that case, we would then consider buying. For a sell signal, when the shorter MA crosses below the longer MA, then it indicates a possible downward trend, and then we will consider selling. So simply put, if your 20-day moving average crosses above the 50-day moving average, it's a buy signal. If the 20-day moving average crosses below the 50-day moving average, it's then a sell signal. So this works best in trending markets, so either moving upwards or downwards. It can produce false signals in choppy or sideways markets, so it's essential to practice and consider other factors like market conditions, risk management, and other confirmation indicators before making these trading decisions. Okay, next, let's take a look at Golden Death Cross. So this is a trading strategy that's based on the intersection of two important moving averages on a price chart. So it's a term used to describe the point at which a shorter term moving average crosses above a longer term moving average. So it indicates a potential bullish trend reversal. Conversely, you can see over here, so when price moves above, it's positive, and in this case, over here, we can then expect it to be bearish. Okay, when the death cross, the death cross will be over here when the shorter term moving average crosses below the longer term moving average, then it indicates a potential bearish trend reversal. Okay, so over here we have the golden cross and here we have the death cross. My last point is confirmation and analysis. So it's important to note that these signals are not foolproof, so you should be using them in combination with the different technical analysis tools as well, like Ichimoku, and a couple of indicators that we're going to talk about in the next few slides. Okay. Next, we have channels. So we already talked about this earlier. But here I've highlighted a resistance level from the previous touch on the trend channel. So at this level, this is my resistance, and you can see price from this swing high, price has actually touched this level, making it an overlap support. But then we see it drop down again, touch the bottom of the channel, and then it's moving within this channel. So since it's continuously moving, and you can see for a really long time, this has really clear upside, or rather upward pressure. And that's why once price breaks through this overlap support or now resistance, then we can say that we can expect it to continue within this upward channel. Okay, so let me know in the chat which one of these looks better to you. Yeah, so the first one definitely looks better. And here we're using a moving average, natural moving average. Okay, let me show you guys the next slide. So now I'm using the natural moving average, and you can see I completely agree the first one definitely looks better. And the reason for this is because price has touched this level many times before it crosses over. So this is actually maybe a better representation of what we can expect for a reversal, or rather how we can identify a trend reversal. Since price has touched it so many times, showing us a really clear upward movement, then whenever there is a crossover over the natural moving average, then we can expect the reversal to be pretty significant. Over here, it's not that this chart is bad. Of course, we're using the same indicator, it's showing us the same things, but the difference between the two is just basically the settings, which is why it doesn't fit as nicely as the first chart. So in this one, once price reverses over here, you can't really tell whether price is actually going to reverse or if it's going to continue in the upward trend. Double break. Simply put, we are just looking for a break out of the trend channel. So this is a very obvious sign that the trend is about to reverse. Once we see this very clear, so we have the natural moving average again, which is the black line, and we are also combining this with our trend channel. So as I mentioned earlier, we need 2 touches at least on top, 2 touches at the bottom at least. So very clear upward pressure here. Looks like it's going to continue. But how we know price is actually going to break out is once we have double confirmation from the crossover on the natural moving average and also breaking out of this ascending trend channel. Okay, so you can see that's exactly what happened. It fell really sharply after that. Okay, next we have confluence. So the first chart, I'm just using a ascending trend channel. And then over here, I've included the trend natural moving average. So by making use of more than one indicator, or I guess trend channel would be a graphical analysis tool. So by combining all of these tools, then you can really increase your chances of making profit or getting out of a trade if the trend reverses. So that's what we mean by confluence. Here we show you some more examples. From the previous slide, we only had the natural moving average as well as the ascending trend channel. Now we've included the Ichimoku cloud, also giving us bullish signal. And now I'm also using the golden cross or death cross technique. Okay, but all pretty bullish over here in this case. Next slide, I'm also using these same indicators here. It's just to show you guys what each of these mean. So because so many of our indicators are giving us this bullish signal, then we can expect price to continue within this ascending trend channel because there are no signs that it's going to break out. So here we can see that's exactly what it did. It bounced off of the bottom of the trend channel and it's continuing within it. Okay, let me know if there are any questions so far. Okay, I have a question. Does this work only for trending markets? So that's a really good question. And the answer to that is we typically would advise to only trade or go in for the trade when markets are trending. And the reason for this is because, and when I say trending, I mean upwards or downwards. Because if it's ranging, there's not much market movement and you cannot really make much money from ranging markets, if that makes sense, because the movements in the markets are what makes you your profits. So all of these techniques that I've gone through today are mostly for trending markets, or not mostly, are all for trending markets, because that's what we typically recommend you to go for, especially if you are a beginner trader, because it's easier to trade when prices are moving up or down as opposed to staying ranging. Okay, I hope that answered your question, but thank you so much for the question. Okay, let's move on. I just have a couple more slides and then I think we can call it a day. So next, let's go through a couple of disadvantages of trend trading and how exactly you can overcome these disadvantages. So firstly, we have false signals. So trend trading can generate false signals as well, especially during periods of market consolidation or trend reversals. So if you act on these incorrect trend assumptions, then it can definitely lead to losses. Next, we have late entries. So what we mean by this is when a trend following strategies may result in entering trades after the trend has already been established. So you can miss out on the initial price movement and potential profits. And then you might see yourself in a position where price is already reversing when you enter the trade. Choppiness is our third disadvantage. So although I mentioned that we are looking for trending markets, you want to stay away from really volatile or choppy markets because these trends tend to be short-lived and erratic, leading to frequent changes in direction and difficulty in capitalizing on sustained trends. So whipsaw trades is a phrase that describes when traders enter and exit positions quickly due to volatile price movements. So these can result in losses, and this typically occurs when rapid changes in price direction occur. So that's pretty similar to choppiness. So don't mistake, when I say trending markets, don't mistake that for choppy markets. Okay, limited profits in ranging markets. So this is also part of my answer to the question from earlier. So trend trading might struggle to generate profits in markets that lack a clear and sustained trend, because these trades may get caught in a range-bound price movement. Okay, requires timely decision making. So when you identify the start and the end of trends accurately, this is pretty difficult to do. So it requires timely decision making and constant monitoring, which may not suit all traders' lifestyles or availabilities. So it really depends on your own trading strategy, whether you are a scalper or if you're in it for the long run. Noisy price data is pretty related to choppiness, so I'll just briefly talk about it. In this case, we're talking about noisy price data or short-term fluctuations, leading to misinterpretation of the underlying trend direction. So how exactly can we overcome these disadvantages? So to overcome these advantages, you can adopt a couple of strategies and techniques. Firstly would be confirmation signals. So we've talked about, for example, for Ichimoku, we're talking about the different lines and what they represent. So these can be used as confirmation signals, or you can use additional technical indicators or chart patterns like we saw earlier when we're talking about confluence and using different indicators to support a trade or to support a trend. So when you use multiple indicators and technical analysis tools to confirm your trend signals before entering a trade, it can help to filter out any false signals and also increase the accuracy of trade entries. Diversification. So you should combine trend trading with other trading styles or strategies to mitigate the risk and reduce reliance on a single approach. So pretty similar to what I talked about confluence. Next, time frame analysis. So I'll talk about this really quickly in the next few slides. Risk management, we talked about this as well. Implementing strict risk management techniques such as setting stop loss, orders, and position sizing based on your risk tolerance. Backtesting and optimization, we have a webinar on this, so you can go ahead and take a look. And market monitoring, it's important. Basically, we're talking about fundamental analysis, and it's really important to regularly monitor the financial events and economic data releases. Okay, so I wanted to talk a bit about time frame analysis. Here we have a very unclear market structure on the M15 timeframe. And there's no clear movements in price. So I talked a bit about that in the previous slides when we're talking about, I think it was support and resistance levels. Next, when we change the same asset or the same price chart to a H1 view, we see it a lot clearer. So there's two criterion you should look out for. Firstly, clear swing high or swing low. Secondly, a clear trend between the starting and ending points. So you can see here I've added a little quote at the very basics. The clearer the swing low and swing high, the clearer the trend between these 2 points, then the more accurate your analysis will be. So this is just an intro, but we have an entire webinar on multi-time frame analysis. But basically, it just involves analyzing the market from multiple time frames. So that's what we're talking about. Okay, so a couple of things to look out for on the higher time frames. We have the key graphical levels, so your support and resistance levels that we mentioned earlier, trend lines, trend channels, breakouts of these trends, and then big moving averages. We talked about those, Ichimoku cloud, big Fibonacci levels, and price action. So what we mean by price action is past, present, future prices, and the momentum from previous bars to dictate your strategy. So you can see how this all ties in. Basically, as long as you use multiple indicators, look at the different time frames, then you can increase your chances of making a profitable trade and trading according to trends. Okay, that's all the time I have for today. And just nice, we are done with our slides. So thank you guys so much for joining me today. I hope you guys found it helpful, and I will see you guys next week. Bye.